Hi, I'm Stacy Burke from Stacy Burke Trading. Would you like to go over position sizing so that you have an advantage between survival and generating big profits? Stay tuned, we'll be right back. Hi, I'm Stacy Burke from Stacy Burke Trading. In our last video on money management, we went over how to manage the percentage of account, planning your risk, your maximum stop loss in terms of controlling that dollar value, your positive expectancy, monitoring your equity curve, and how you can use money management strategies to generate big profits when you're doing well and to reduce your losses when your trading isn't going so well. Today what we're going to go over is position sizing. That's the other component of the money management strategy. Basically, position sizing takes into account three areas: your account size, how much risk or percentage of your account are you willing to risk on each trade, and with that's a personal decision in terms of what your comfort level is, how aggressive you're trading. Everybody will have their own level of comfort in terms of what their risk tolerance is. So this is just a basic model to give you some fundamental understandings, but you must use position sizing with your money management to ensure your consistency in terms of your losses, but also in controlling your account from being damaged or destroyed. The third part of that is your stop loss. The maximum stop loss in any situation, whether that's a technical loss in terms of where you've identified on a chart where your trade that you might have entered into would be invalidated, but also in case of any unforeseen events that might come into the market, if you don't have a stop in place to limit your theoretical maximum loss, then the damage can just run on and potentially destroy your account, and in some situations possibly put you into a situation where you owe money. So you always want to be focusing on these three things. Now for today's example, we'll use a hypothetical account size of $10,000. Now if it's a mini account, we'll call it 1,000, but for this example we'll talk about 10K. If we want to take a maximum exposure of 2% on any one trade, our risk exposure level then in this particular case would be $200. So what we've taken in there is that we're taking a trade based on our account size. We could take a 2% risk, and that maximum risk that we're going to put our technical stop loss into the market at would have no greater than $200. So the third part of that is our stop loss. So if we were to take a trade, say where for simplicity's sake, our maximum stop loss was 100 pips, and we're going to risk 2%, which is our $200, that would mean that each pip has roughly a pip value of $2. Now, depending on which currency you're trading in, you may need to identify that amount in the currency that you're trading in. For example, if I'm in Australia, that might be worth $1.10 a pip. So identify that in the currency that you're trading in, but for simplicity we'll talk in US dollar accounts. So basically, if we were to do $200, that's $2 a pip to hit our maximum stop loss. That means if we were trading mini lots, we would take 2 mini lots with a maximum stop loss of 100 pips, and that would equal our $200. So what we've done in that case is we've identified our trade, but we've limited the downside. So often traders emotionally look at the chart, the first thing they think of is that this trade is going to take off and it's going to make me a lot of money. And it's so obvious, I got to get on board now. They get into the trade and then they decide where they're going to put their stop. They haven't used their money management or position sizing rules, and the obvious trades are usually the ones that fail. As that trade starts to go against them, a lot of new traders will move their stop because they feel that the market will revert at some point and allow them to get out at break even, and those are often the trades that start to accelerate and go against them even more. Usually where there's a technical level where there's a stop, there'll be other orders where the market might be reversing its positions, not only as stop loss orders, but on stop orders to enter new trades into the market. So it's critical that you always use your money management rules and your position sizing to put your stop loss into the market to limit the downside on any one trade. If you take care of the downside, the upside will take care of itself. The same rules apply for a micro lot account, and in our next video we'll show how you can use a micro lot account and trade it like a large fund to focus on the trading process and then eventually grow that into a larger account. I hope you got some value out of today's video. Always stay disciplined, stay focused, use your money management rules. That's the secret between surviving and destroying your account and generating big profits. That's the difference between amateur traders and professional traders. Stay focused, stay disciplined, and may the markets go with you. Hi traders, it's Stacy Burke from Stacy Burke Trading. If you haven't done so, please head over to my website at stacyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.